we will discuss about the three types of investment. Okay, in the business fixed investment, dividing into 6 sub-chapters. The first one is the capital rental market, the cost of capital, the taxes and investment determinant, Tobin's theory, and the last one is a financial constraint. We can say the standard model of business fixed investment is the neoclassical model of investment. And it shows how the investment depends on the MPK, interest rate, and the tax rules affecting firm. To develop this model, imagine there are two kinds of firm in the economics. Production firm rent their capital they use to produce goods and services, and the rental firms they run capital rent to its production firm. So in this context, investment is the rental firm spending on the new capital goods. In the capital rental market, production firms must decide how much capital to rent. The competitive firms rent capital to the point where marginal productivity of capital are equal with the real rental price per price. And the figure in the right side shows the equilibrium in the rental market for capital. For the reason just discussed, the marginal product of capital determines the demand curve. The demand curve slopes downward because the marginal product of the capital is low when the level of capital is high. At any point in time, the amount of capital in the economy is fixed, so the supply of curve is vertical. The real rental price of capital adjusts to equilibrate supply and demand. Okay, so we move to the factors that affect the rental price. For the Cobb-Douglas production function, y equal with a k squared with alpha, l squared with 1 minus alpha. To see what the variable influence the equilibrium rental price, let's consider the Cobb-Douglas production for a good approximation of how the actual economy turns capital and labor into goods and services, where y is output, k is capital, l is labor, a is a parameter measuring the level of technology, and the alpha is a parameter between 0 and 1 that measures capital share of the output. With the marginal product of capital for the Cobb-Douglas production, the function is marginal production of capital equal with alpha multiplied with a and l per k square 1 minus alpha. Because the real rental price equals the marginal product of capital in equilibrium, so we can write as R per P equal with alpha AL per K square root 1 minus alpha. And this expression identifies the variable that determine in the rental price. It shows that the lower the stock of capital, the higher the real rental price of capital. The greater the amount of labor employed, the higher the real rental price of capital. And the last one is the better of technology, the higher the real rental price of capital. Rental firms' investment decision. Rental firms invest the new capital when benefit of doing so exceed the cost. And the benefit per unit capital, the income that rental firm earn from renting the unit of capital to production firm. Next, we move to the cost of the capital. There are three components of the cost of capital. The first one is interest cost, depreciation cost, and capital loss. To make the expression for the cost of capital simpler and easier to interpret, we assume that the price of capital goods rise with the price of the other goods. In this case, delta PK divided into PK equals to the overall rate of inflation, or P, because I minus P equal the real interest rate, or R. We can write the cost of capital as the equation below. This equation states that the cost of capital depends on the price of capital, the real interest rate, and the depreciation rate. And finally, we want to express the cost of capital relative to other goods in the economy. The real cost of capital is the cost of buying and renting out a unit capital measured in the units of the economic output. The firm's decision regarding its capital stock, that is whether to add to it or to let it depreciate, depend on the whether owning and the renting out capital is profitable. The change in the capital stock called the net investment. So the net investment depends on the difference between the marginal production of capital and the cost of the capital. If the marginal product of capital exceeds the cost of capital, firms find it profitable to add their capital stock. If the marginal product of capital falls short of the cost of capital, they let their capital stock shrink. So from the equation above, we will know about the ln in the function is showing how the net investment responds to the incentive to invest. In the investment function, the curve shows that an increase in R raises the cost of capital, reduces the profit rate, and then reduces the investment. And the next one, an increase in marginal productivity of capital or decrease in PK dividing P make the increase the profit rate, increase the investment at any given interest rate, and the shift I curve to the right. Then we also make the conclusion that shows that the business fixed investment increase when the interest rate fall. This is because a lower interest rate reduces the cost of capital and therefore make owning capital more profitable. And this shows that an outward shift in the investment function, which might be due to an increase in the marginal production of the capital. Taxes and investment. Here, we consider two of the most important provisions of corporate taxation. The first one is the corporate income tax and the investment tax credit. The corporate income tax is a tax on the corporate profit. Then, the investment tax credit is a tax provision that reduces firm taxes by a certain amount of each dollar spent on capital goods. So why the corporate income tax give an impact on investment depend on definition of profit. In our definition, depreciation cost measuring using current price of capital and the CID will not affect investment. If PK rises over time, then the legal definition understands the true cost and overstate profit, so firms could not be taxed even if their true economic profit is zero. Thus, corporate income tax discourage investment.
Selanjutnya, untuk mengetahui rasio antara nilai modal dan nilai penggantinya, terbentuklah Tobin's Q, yang bertujuan untuk mengetahui rasio antara nilai modal yang ditentukan oleh harga saham mereka di pasar saham dan nilai penggantinya. Formula Tobin's Q ini adalah Q equals market value of installed capital divided by replacement cost of installed capital. Dengan pembilangannya itu nilai pasar saham dari persediaan modal ekonomi dan penyebutnya itu adalah biaya aktual untuk mengganti barang modal yang dibeli ketika stok dikeluarkan. Maka jika Q lebih besar daripada 1, itu menandakan bahwa perusahaan membeli lebih banyak modal untuk meningkatkan nilai pasar perusahaan mereka. Sedangkan jika Q lebih kurang dari 1, maka perusahaan ini tidak menggantikan modal yang kurun sedang aus atau berkurang. Other than affecting the function of GDP, if the fall of stock prices, this might reflect bad news about the technological progress and long-run economic growth. This also implies that the aggregate supply and full employment output will be expanding slowly than people had expected. Other than what has been mentioned above, there's also the alternative views of the stock market called the efficiency market hypothesis. The main point of the efficiency market hypothesis, or the EMH, is the market price of a company's stock is the fully rational valuation of the company, if given the current information about the company's business prospects. The second is the stock market is informationally efficient, meaning that each stock price reflects all available information about the stock. And the third is that implies that stock prices should follow a random walk or be unpredictable and should only change as new information arrive. Alongside the EMH, there's also the Keynes beauty contest. A beauty contest is the idea based on newspaper beauty contests in which a reader wins a prize if he or she picks the woman most frequently selected by other readers as most beautiful. Thus, Keynes concluded proposing that stock prices reflect people's views about what other people think will happen to the stock prices, or in this case, the best investors could outguess the mass psychology. Keynes also believed that stock prices reflect irrationally waves of pessimism or optimism. In other words, animal spirits. Next is financing constraints. In the neoclassical theory, it assumes that firms can borrow from the bank to buy capital whenever doing so is profitable for both the firms and the bank. But over time, it has been proven wrong, because some firms are facing financing constraints or the limits on the amounts they can borrow. And thus it's causing a recession, reducing current profits. If the future profits expected to be high and the investment might be worthwhile. But if the firm is facing financing constraints at that time and the current profits are low, then the firms might unable to obtain funds. And what follows next is the residential investment. How to determine the residential investment is depending on the relative price of housing. The relative price of housing is determined by the supply and demand in the market for already existing house. To have a better understanding, we now show the graphic for the equilibrium prices of house. The supply is at a steady rate, meaning that it shows us that of a supply of already existing house, while the demand is at the curving point. Thus, we now know the supply and demand for the equilibrium price of houses. With the equilibrium price of houses then determines the residential investment. Next is, if the fall on stock prices, it will reduce household wealth, shift the consumption function down, and cause a negative aggregate demand shock. Dengan kata lain, jika stock prices itu turun, maka fungsi-fungsi yang mempengaruhi GDP pun juga akan turun, begitu. And if there's an interest rate fall, then the demand will increase, shifting the graphic to the right, meaning that the demand will always increase as the interest rates fall, causing the flow of residential investment also to going upwards.
The tax treatment of housing. The tax code, in effect, subsidizes home ownership by allowing people to deduct mortgage interest. The deduction applies to the nominal mortgage rate, so the subsidy is higher when inflation and nominal mortgage rate are high than when they are low. Some economists think this subsidy causes over-investment in housing relative to other forms of capital, but eliminating the mortgage interest deduction would be politically difficult. Inventory investment. Inventory investment is only about 1% of GDP. Yet, in a typical recession, more than half of the fall in spending is due to a fall in inventory investment. Motives for holding inventories. For the first, production smoothing. Sales fluctuated, but many firms find it cheaper to produce at a steady rate. When the production is more than sales, it will be inventories rise, and when sales is more than production, inventories will fall. And the number one, inventories as a factor of production. Inventories allow some firms to operate more efficiently. Sample for retail sales product purpose, spare parts for when machines break down. And the number three, stock out avoidance to prevent lost sales when demand is higher than expected. And the number four, work in process. Goods not yet completed are accounted in inventory. The Accelerator Model, a simple theory that explains the behavior of inventory investment without endorsing any particular motive. The Accelerator Model, notation N stock of inventories and delta N inventory street investment. Assume firms hold a stock of inventories proportional to their output. It means N equal BY, where B is an exogenous parameter reflecting firms' desired stock of inventory as a proportion of output. The result is delta N equal B delta Y. Inventory investment is proportional to the change in output. When output is rising, firms increase inventories, and when output is falling, firms allow their inventories to run down. This is the evidence for the accelerator model. The blue line across from the 1982 until 2004. It shows in America the investment is always higher in the up of the blue line, and minimum of the year is under in the blue line. A numerical figure except that the data main queue gave me to construct this graph are in $1996, whereas the data used to construct figure 14.4 17.7 in the textbook are in $2,000. This scatter plot shows that inventory investment is high in years when real GDP rises and low in the year when real GDP falls, just as the accelerator model predicts. Inventories and the real interest rate. The opportunity cost of holding goods in inventory, the interest that could have been earned on the revenue from selling those goods. Hence, inventory investment depends on the real interest rate.
Thank you for your attention and see you